And just to warn you, I'm having some technical issues as is the way, but yes, hopefully I won't cut out, and if so, my colleague Dan Rogers will join, will take over. Brilliant, thank you. Then today we're looking at innovative financing's potential to drive sustainability in the built environment sector, and we're really pleased to launch our paper today too, which will be online as well. Next slide, please. So I'm Natalie Record, I'm Housing Innovation Lead at Connected Places Catapult. I joined from the Ministry of Housing, Communities and Local Government to take it back in November to take over sort of housing innovation strategy at the Catapult. We're currently focusing on healthy ageing, innovative finance and retrofit, and we're also looking at the wider sustainable housing sort of transformation in the UK and internationally. We're really, really excited to engage with you all today and really looking forward to this event. Next slide, please. Great, so the agenda for today, you'll have a welcome and introduction from me in explaining Connected Places Catapult's the vision in this space and how we came to write this paper. Then I'll be passing over to Vivid Economics, our partner in this space, who will be presenting on market trends. Shally will be presenting on that. And then over to Anna at Vivid Economics to look at challenges and barriers. And then we'll look at the case study with Joey from Curve Block. Then we'll go into a panel discussion chaired by Dan Rogers, our colleague at Connected Places Catapult. And then we shall go into an audience Q&A, and then we'll have a wrap up and summary and next steps. Next slide, please. So a little bit about the Catapult itself. For those who may not have engaged with us before, the Catapults are a network of world-leading centres designed to transform and accelerate the UK's capability for innovation and future economic growth. Connected Places Catapult is the UK's innovation accelerator for cities, transport and places, and we seek to connect stakeholders across markets and ecosystems. We also look to spark new innovation and investment and accelerate commercial success for innovative UK firms. Next slide, please. So, a road to retrofit. So in 2020, Connected Places Catapult published a retrofit towards the sector-wide roadmap, which is on our website, and also hosted a housing innovation week, which several of you may have attended. Through this work, we set out the important role of innovation to create homes fit for the future, practical actions required across the built environment industry to support the shift towards adoption of innovation, and the need for innovative financing solutions and investment to support the adoption of new technologies to create homes fit for the future. Next slide, please. So, building upon our findings and our previous work, we partnered with Vivid Economics to today launch our new report, which explores how innovative financing technologies and tools are being developed and adopted to help scale UK residential decarbonisation, practical areas where the built environment industry can action in the pursuit of decarbonising the residential built environment, and opportunities for collaboration to test and demonstrate new technologies to transform the sector more holistically. And here to the left is the front cover of our new report, which is on our website, entitled Financing Innovation and Transformation in the UK Residential Built Environment Sector. Next slide, please. So, in order to do this, our work is drawn upon the expert input across a variety of different stakeholders and is relevant to investors, policymakers, innovators, construction and housing firms, and technology suppliers. And in this event, we'll explore the opportunities to learn about more about potential in this space to help shape interventions and drive a wider application of innovative financing to deliver sustainability in the built environment sector. Next slide, please. So you may be wondering what Connected Places Catapult's role is in moving this forward. We haven't particularly looked into finance before as in our work, so you may be interested in what we're thinking. So we are uniquely positioned as Connected Places Catapult to support the built environment industry and their next steps to decarbonise housing stock and creation of net zero places and communities through the following. So convening key stakeholders and ecosystems to work collaboratively, connecting them with SMEs and innovators to collectively solve problems. We also are experts in providing testbed and piloting expertise to drive deployment of innovative technologies and to demonstrate new approaches for better outcomes. And we're also experts in designing the business case and action plan for decarbonisation of housing stock and looking to support the transition to net zero places, tackling market barriers and accelerating the scale up of innovation. Next slide, please. So I'll now hand over to my colleague Shally at Vivid Economics, who will take you through the market trends identified in our report today. Over to you, Shally.
Thank you so much, Natalie, for that kind introduction. And we at Vivid Economics were very fortunate to work on this project alongside the CPC team. And we've also had a great body of work for us to draw from, including work done by the Green Finance Institute, the Urban Land Institute, and many others who have been, actively searching for solutions in this space. The sustainability challenge really looms large in the UK residential built environment, and the UK Climate Change Committee has created pathways towards a net zero future for buildings. And within those pathways, the residential sector was clearly one of the most important priorities. And so for this report, we focus specifically on low carbon heat as well as energy efficiency measures. But, to be clear, the whole sort of conversation around sustainable placemaking is a much broader one to have, and one where innovative financing will certainly be another important issue to look at. So before we jump into the finance itself, I wanted to talk about some of the innovative, some of the importance of the role of finance in the net zero transition. So if you could give me a second, I'm trying to figure out how to move the slides. I don't think, yes, okay. All right, it's working. Sorry about that. So, so let's talk about the role of finance in creating this transition to net zero. So right now, we're all the way on the right here, the dominant regime. So emissions intensive homes with limited decarbonization pathways. 14% of UK's total emissions are attributable to the residential built environment specifically, and that's direct emissions. What does this mean? Well, we have a pretty important challenge with deeply retrofitting our existing housing stock, which is old and drafty. So 1.7 homes require retrofits per minute, every minute between now and 2030. And that's going to cost 250 billion pounds over the next 30 years, and more specifically within the next decade, where investment needs peak. So the question is, how do we disrupt this dominant regime on the left to get to a place where we're thinking about sustainable placemaking more holistically and specifically meeting our net zero targets? First, let's look at a few things that are on the horizon. So we're seeing some landscape changes and opportunities, as you see in the top. And particularly in the last few years, a dramatic interest in from both the public sector as well as the private sector in meeting net zero targets. So 2/3 of housing associations right now have plans are currently undertaking plans to get to net zero by 2050. And we're seeing large developers like Thacum, for example, having net zero commitments for all of their new builds within the next decade. And we're also seeing innovative developers like C2 who are coming in and trying to create entirely new transformational neighborhoods. On the investment side, there's been a huge uptick in interest in net zero investments across a wide variety of asset classes, including the housing related asset classes. So 160% growth in venture capital investment since 2018, including in net zero technologies. $9 trillion of assets, institutional assets under management have committed to net zero emissions portfolios. And the green bond markets are growing rapidly. So as of December 2020, there's about $1 trillion in cumulative bond issuance, and that number is expected to shoot up. So Peabody, Clarion, Astor, and L&Q are all among the housing associations that are using capital markets right now to fund green or social impact projects. Clarion specifically raised a £350 million green bond. It was a 12-year green bond last year. And this green bond achieved a coupon rate or interest rate of 1.25%. That breaks the record for any interest or coupon rate for primary bond issuance by a housing association. So clearly we're seeing from some pretty significant momentum in these markets, especially when you consider the rise of traditional energy costs, the low interest rate environment that we're in, and the plethora of new technologies coming into the market. How do we sustain this momentum and get us to the net zero pathway? We need 3 ingredients. The first, on the bottom left here, are enabling conditions. We need robust regulations, labor reskilling, awareness raising to stimulate demand for low carbon solutions, as well as strict performance standards and enforcement. The second ingredient is emerging innovations. We need to support innovative low carbon finance technologies and delivery models for both individuals as well as communities. And this is the key ingredient to disrupting the dominant regime here on the left. And finally, we need catalytic finance. So innovative and catalytic instruments, blended finance arrangements to help finance this disruption, whether from innovation or direct investment, so we can get to a net zero transition. It's these 2 arrows that I'm going to focus on today. So on one side, emerging innovations, and on the other, catalytic finance. With financing innovations, these are on the left here in green, these are innovative business models that embed finance into technology and delivery. And on the right here in orange, catalytic finance, financial instruments and vehicles that can jumpstart and scale the net zero transition. I'm going to highlight a few case studies that show this pairing. So financing innovations on one side and the catalytic finance on the other side to scale those innovations. But certainly beyond innovations, there are lots of traditional financing instruments, and many of these are explained in our report. And I strongly encourage you to read through our report to learn more about other case studies, what these innovations are, how these instruments work, and generally get a better sense of what's happening in the market. So let's start with energy or heat as a service. This squarely fits into the first model. So this is an innovative financing plus delivery model that provides customers with a solution for decarbonization. In these types of models, a third-party company, as you see here on your left in green, provides energy or heat as a service to the customer in the gray box on your right. So this customer can be a homeowner, a landlord, or a social housing provider. In the case of energy as a service, the residential occupant pays for the energy and receives energy savings due to their improvements that have been undertaken by the energy or heat supplier. In the case of heat as a service, the customer signs up and pays for warm hours rather than paying for energy. So it's as you might with a phone plan, for example. The Energy Catapult has been testing this model to figure out whether customers might be more attracted to buying warmth, which they can see as a benefit, rather than buying down energy bills, which can be a little hard to quantify and get their mind around. So these types of models address several barriers in the market, namely the fact that as an individual homeowner, landlord, or social housing provider, you may not have a good sense of what the technologies are that are out there. You may be hesitant to make that large upfront investment and worried about the performance technology risks of low carbon investment, whether they're an air source heat pump or insulation measures. And this type of model takes those risks away from the customer and in some sense puts them on to the energy or heat supplier who may be better positioned to absorb these risks. Nevertheless, these models still face some important challenges. So as I mentioned, the energy or heat supplier faces a fair amount of risk related to the technology and the performance of these low carbon installments, but they also face default and cancellation risk. So that's the risk that the customer doesn't pay them back or they default on their contract. And as a service provider is not a financial institution per se, so it's hard for them to manage these risks or diversify their portfolio in a way that would let them manage these risks cheaply. As a service providers have high upfront marketing costs, especially in the case of individual homes and trying to reach customers at the right tipping points to have them interested in these services. So for example, when their gas-fed boiler is ready for replacement. And the final challenge, because of the innovative nature of these models or the newness of these models in the market, is attracting low-cost finance. With this last challenge in particular, finance itself can help attract more finance. And let's talk about how this looks. So on this next slide here, we have the example of RENESCO and LaBeef. RENESCO is an energy services company that operates in Latvia. And LaBeef is the Latvian Baltic Energy Efficiency Facility that was created to support RENESCO and other ESCOs. So RENESCO retrofits apartment blocks to improve Soviet-era housing, both in terms of energy efficiency, but also living comfort. So you can see here on the top left that RENESCO, the energy or heat supplier, enters into a standard energy performance contract with a multi-family building landlord, which is the green icon here on the left. In exchange for undertaking these initial renovations and guaranteeing energy savings, the landlord returns to RENESCO fixed payments. RENESCO finances these investments by working with a commercial bank, as you see here on your right, and this can be through a credit line or a loan, and they have to return financing payments to this commercial bank. So one of the key challenges with this model, as I mentioned before, is that RENESCO takes on a fair amount of financing risk. So the risk that the energy performance contract is defaulted on or canceled. And this is where LaBeef comes in. So here on the bottom right, LaBeef in the dark orange is a funding facility. It's a self-funded financing facility that's set up with public and or private money. And that money can be in the form of financing or in the form of shares. So LaBeef sets up this facility, and through a process called forfeiture, they take on the energy performance contract into the facility. And that means that all the debts and repayments of that energy performance contract come in to LaBeef. LaBeef, however, does not want to take on the delivery risk because they don't know much about performance and maintenance. So they return the delivery risk back to RENESCO and in return give them 20% of all of the repayments. So it seems like a bit of a complex structure, but it's actually quite simple, not from a contractual perspective, but from a theoretical perspective, which is RENESCO is essentially taking all of the financing risk associated with that energy performance contract and handing it over to LaBeef. Conceivably, LaBeef has several of these ESCO contracts, and so they're able to diversify that risk away within the funding facility. The other key benefit of a platform like LaBeef is that it's able to add transparency and scalability into the market by standardizing these energy performance contracts and making sure that there's a clear process every step of the way for every ESCO project. And finally, because the ESCO has gotten rid of the financing risk and the actual financing arrangement, they're able to then free up capital to move on to other projects. So here, just to sum up, we saw an example of a heat or energy as a service model, which embeds finance to the finance seeker, in this case, multifamily building landlords. And then we can bundle these ESCO contracts into a facility like LaBeef, which adds scale and streamlines transaction costs for ESCOs so that the ESCO can then go on and scale. So let's look at another example. In the US and increasingly in Europe, there is an instrument called Property Assessed Clean Energy, or PACE. And these PACE schemes allow a property owner to finance the upfront costs of energy or other eligible improvements on a property, and then pay these costs back over time through their property tax, or in this case, local council taxes. So the key feature of PACE is that both the installation of low carbon improvements, as well as the debt associated with repaying for those installations, is recorded on the property registry, as you see here on the bottom. And this is really important because it removes split incentives between current and future homeowners. So if a new, if the customer sells their home to a new buyer, the property and the assets related with the low carbon development would move into that customer's mortgage. Now, PACE is a pretty important instrument because it allows a property owner to avoid paying upfront for these low carbon installations, and to make sure that the installations are fit for purpose. So because the local government works with a PACE certified contractor, they're essentially able to reduce the performance risks of these arrangements. Still, there are lots of challenges to implementing PACE, particularly in the UK setting. So a EuroPACE report identified the UK as a moderately adequate country for this type of financing. And in fact, we have the legal framework and enforceability framework to collect council taxes for this purpose. But what we don't have is the municipal capacity, the social perception, and the acceptance within the UK to implement such a program. If we're able to get past those barriers, there are some interesting instruments that help us scale these PACE programs. And I want to talk through one of them, which is WHEEL. So WHEEL is a securitization platform. And it actually began because there was a state sponsor of PACE programs within the state of Pennsylvania. And they found that there was so much demand for their PACE programs, but they just didn't have the ability to recycle capital to provide more loans within their PACE scheme. And that's how WHEEL started. So within the WHEEL arrangement, a state sponsor transfers funds into a custodial account within WHEEL and works with their loan originators to create a pool of energy efficiency loans. These energy efficiency loans are housed within a warehouse facility within the WHEEL securitization platform. Once we get to a critical mass of these loans, the securitization platform issues what's called an asset-backed security. So that's a security that's backed by the repayments into the PACE program, and issues that security to institutional investors. Institutional investors are interested in this type of instrument because it provides them with an ability to take on different levels of risk and return. It also gives them a steady cash flow in an asset that they have confidence in, the housing sector, and they invest that security. And beyond that, after they invest in that security, the WHEEL securitization platform becomes recapitalized, and that note can be resold again. the state sponsor can come in and de-risk institutional investors' positions in these asset-backed securities even further by either providing backstops or guarantees on that asset-backed security. And that's an important feature because it allows the state sponsor to buy down the interest rates for borrowers interested in the PACE program and do it cheaply rather than just providing a straight discount. Now, these this arrangement of wheel securitization is relatively new in the market. And as I'm sure many of you are thinking, the whole concept of securitization in housing markets is really, makes us all think about the financial crisis and the housing crisis of 2008. And I think the key thing to keep in mind with implementing these kinds of programs is that they have to be accompanied by the right regulatory environment and financial stability measures to ensure that we can keep the net zero transition sustainable as well. So we've now talked through two examples of how innovative finance can be married with catalytic finance in order to scale towards the net zero transition. But sometimes traditional financing instruments can be innovative with a little tweak. So I want to go back to a simple example of green mortgages. These green mortgages are increasingly being offered by some of the major mortgage lenders in the UK, including Nationwide, NatWest, Lloyds, Barclays, and many others who've been in the market for a long time, like the Ecological Building Society. The arrangement is pretty simple. So a mortgage lender, for example, for a new build would provide a green mortgage or a discounted mortgage, so long as that property met certain EPC requirements or other low carbon certification requirements. And in exchange, the home buyer would repay their principal and interest. So on an average loan of £150,000, the home buyer might save up to £750 by paying a lower interest rate. There's another variation of this arrangement where the mortgage is bundled with a renovation loan. So an existing mortgage would come with a green renovation loan, and that could have favorable terms on the interest rate for a short period, or there could be more leniency on measuring the amount or the maximum loan size that the customer could take on. So these instruments are relatively simple, but they face key challenges. One, and the main one is consumer barriers. So whether it's individual homeowners or even housing associations, there's hesitancy to directly make investments in decarbonization because of the uncertainty around the cost, but also lack of knowledge about what the options are and how they're going to work. And split incentives are another key challenge. So a landlord, for example, may not be willing to decarbonize because they don't see the benefits of that in their energy bills. And finally, there are limited touch points, especially in the case of retrofits, to reach customers who might be open and interested to, for example, changing their gas-fed boiler to an air source heat pump system. Luckily, we have some solutions to these challenges for the consumer. And Anna, my colleague, is going to talk about some of them later on in her presentation. But there's also a third-party solution that can help. So Retrofit Works is a good example of a one-stop shop where a customer can go to Retrofit Works, and Retrofit Works can help them create a plan for their home. There are different variations on the retrofit model. There's also a concept of building passports, and these can be digital building passports. They're essentially a roadmap for each customer in their home to figure out how to decarbonize. And in addition to that, how to reach the financing that's necessary to decarbonize. So Retrofit Works or other platforms like this can connect a customer to a mortgage lender or an ESCO to stimulate their demand in decarbonization. So we've gone through a couple of examples here, and we've seen how catalytic finance can help jumpstart the net zero transition alongside innovation. At the end of the day, what's very important is that finance is able to finance, the supply of finance can meet the demand for finance at the right key tipping points. So for finance seekers, private homes, that includes when they're going to buy a new home or when they're thinking about replacing their gas-fed boiler. But we can also stimulate that demand by direct education programs. In the case of social housing providers, for new builds, there are lots of opportunities to use green loans and bonds and securitized products in order to create access to low cost and cheap finance for new buildings. For retrofits, it's a bit more complicated because there's no revenue stream that is clear and certain from the retrofitting process. So using finance embedded delivery options like the innovative, as a service or ESCO options are really great solution for social housing providers. And finally, financing providers themselves need investment, and there's lots of new instruments in the market that we talk about in our report to support this. So in closing, as I mentioned before, the role of finance is quite important in getting us the 250 billion pounds in investment that we need over the next 30 years. And the question is, how do we bring together the right enabling conditions alongside the innovation that will disrupt the current emissions intensive regime? And finally, how will we use catalytic finance to scale that disruption and get us to net zero in the most fast and effective way possible? So thank you so much, and I'm looking forward to all of your questions. And again, highly encourage you to read the report to learn a lot more about these financing instruments and also the role of finance in getting us to net zero. Thanks so much, Natalie. I'll leave it to you.
Thank you so much, Natalie. And thank you very much. Yes, so next slide, please. Brilliant. So now passing over to our colleague Anna at Vivid Economics to take us through the challenges and barriers. Over to you, Anna.
Thanks, Natalie. I want to reiterate what Shali was saying. It is a really exciting time in the built environment, specifically in the UK. It's undeniable that momentum is growing, and there's all these innovative business models and financial products out there that give us opportunities both to materially improve our homes, as well as create lasting value for all stakeholders. However, there are challenges to this transformation, to grasping these opportunities and to scaling these innovative business models or financial products. And I want to take a little bit of time today to go through some of these challenges at a bit of a broader level, and then also present a few financial solutions or solutions more broadly that we can apply just to give us a flavor of what can be done in the future. So starting first with our challenges, looking at our financing innovations category, so we're a little bit more related to our delivery and our business models. The challenges that we kept seeing in our analysis and through our stakeholder interviews is what I think you'd typically expect from new business models. So there's a need for external funding in order to really kickstart these models. A lot of energy efficiency or low carbon heat improvements having high upfront costs. This can be quite a significant challenge even for these new businesses. Then secondly, there's a bit of a need for scale for some of these models to become financially self-sustaining. And the last two challenges that kept being referred to were related to uncertainty, both in terms of regulatory uncertainty, very direct things like what are building regulations going to look like, or how much are we going to be able to operate in these markets, but also more broad regulations and policies as well. And then uncertainty related to the business models themselves. Some of them are at pilot stage, trying to gather enough information and data in order to almost set their rates correctly. But there is a little bit of an inherent risk with any kind of innovative business model here, and that requires further support. In terms of what we're calling catalytic finance, which does include our kind of dedicated financial products, things like, for example, green mortgages, the challenges here are quite different. One thing that kept coming up during some of the interviews was that banks or financial institutions would tell us that they do have these dedicated financial products, but they just see really low take up from their customer base. Another concern or another challenge that we see potentially or more linked to local authorities and housing associations is connected to if there's capacity, interest, or even willingness to implement some of these larger financial products. One of the case studies that we have in the report is related to sustainability bonds issued by housing associations. Charlie quickly mentioned Clarion, but truth is issuing a sustainability bonds requires going through an ESG credentials assessment, and that might not be something that all social housing providers will be interested or have the capacity to do as well. And the last challenge that we see here really is related to the risk and uncertainty kind of underlying the projects at the source of these investments. With energy efficiency and low carbon heat improvements, there is almost like a little bit of an error margin to how much of the promised savings will actually be realized. So a little bit of uncertainty there. And there's still inconclusive evidence as to how much, again, energy savings, energy efficiency improvements, for example, can improve sale values or even rental values. We did identify a little bit of a positive correlation, but in broad terms, the evidence is still not very conclusive on that side. So again, a few risks associated with these new products and new improvements as well. But there are solutions to these challenges, and solutions that employ different channels of impact and that involve different stakeholders. And today I want to talk us through just 5 potential solutions, again, to give us a flavor of what could be done. And starting first with having funds or funding facilities that take on the financing risk of innovation. Charlie talked us through the example of the LaBeef funding facility and how it took on the financing risk from RENESCO, which is an energy services company. But this could also be applied to other innovative delivery models like heat as a service, energy as a service as well. Another solution that we could see is increasing or encouraging further demonstration projects, specifically with housing associations and local authorities. Again, particularly good for our finance embedded delivery models. And this is because local authorities, housing associations, or social housing providers just have the scale needed to implement these projects and can help providers gather data and information needed to reduce a little bit of that business model uncertainty that we were talking about. And the next 3 solutions, I want to go a little bit more into detail. Starting first with public guarantees. So of course here, a guarantor takes on the debt or the liability of a borrower in case of default. And this ultimately reduces risk by providing investors with security. And by doing this, borrowers can actually get better deals, very often usually lower rates on their products. But I think another interesting thing that public guarantees can do is actually introduce investors to these innovative either delivery models or financial products at a very low risk. So again, increasing awareness for these things, not only in the demand for finance, but also on the supply for finance side. And more practically, we could see guarantees being issued perhaps through existing or new government guarantee schemes, or even perhaps through a public entity like the UK National Infrastructure Bank. And additionally, guarantees can also come in at different levels of the financing waterfall. So if we have a housing association here on the left, taking out a loan or any kind of financial product from an aggregator, a facility, or a borrower here in the middle, the guarantee can come in at that initial stage, and the housing association immediately or very directly benefits from lower rates. But we could also see guarantees coming in at a later stage of the waterfall when we are trying to access capital markets and institutional investors. And again, the housing association or the borrower would again benefit from these lower rates being passed down. Another solution that I want to mention today is related to the improving point of sale advice, which is specific, very relevant for our catalytic innovation, our dedicated financial products. And I do mean point of sale advice in a quite broad way, including the whole value chain, almost the whole system within a bank. And this can both increase, of course, consumer awareness, one of the challenges that we identified. It can drive consumer demand even, but it can also create internal processes within a bank that can facilitate the rollout of these financial products. So in a way, we're trying to almost make a business case to our customers about these dedicated financial products, but also later on prove this business case internally in the bank itself. And the way we could see this happening is if we have a bank or financial institution that's about to provide any kind of product in a housing context, they would make use of almost these standardized or optimized components, these light green boxes at the bottom here, that they could easily reach out for. So of course, when dealing with a customer, the first thing that they could reach out for is, for example, a marketing suite full of materials that could help them make this business case to the client. And that could also be passed on to any kind of intermediaries that the bank deals with. But then we also want to see, again, standardized or optimized components, perhaps some process or some guidelines for appraisal and underwriting of any kind of product that deals with sustainability or energy efficiency in the housing context. And again, it's all about trying to get banks to internalize the value of energy efficiency and low carbon heat improvements. And what could then be additional to these point of sale bundles is then a connection to external, for example, as a service models or government supports in the form of grants, insurance, or potentially even a link to house builders, contractors. And of course, this will involve increasing capacity, in front office, in back office, potentially even in intermediaries, but it can be a really useful tool to almost rejig both the demand for finance and the supply of finance. And I mean green finance here. And for my very last point, I realize we've given very almost targeted and practical solutions. And I want to get us thinking about how we can integrate finance almost into the next frontier of sustainability in the built environment. And this is to help us truly scale and reach economy-wide net zero goals and not just housing targets. And this involves thinking holistically about sustainability in the built environment through neighborhood approaches. Again, this is something that did come up a lot when we were having our stakeholder interviews, is to avoid falling into this trap where we are able to build these low emissions, build and finance, of course, these low emissions buildings or developments, and then see these developments have quite high, for example, transport emissions because the residents there use their combustion cars to drive in and out. And of course, this will involve a big shift in the mindset of both policymakers, but also decision makers more broadly. But there are interesting ways that finance can be linked to these, or that finance can participate in these decision makings. And one example of this that we do go into a little bit more in the report itself as well is the Remo Urban project, which aimed at piloting what could be smart cities. And one of these smart cities was Nottingham. And here, sustainability was considered quite broadly. So they looked both at retrofitting buildings, but also sustainable mobility and infrastructure. And the way that decisions were made was that different stakeholders were brought together, and then they would decide collaboratively on, firstly, what kind of technologies or choices they were going to make, perhaps choices related to mobility for are we talking about EV charging infrastructure or perhaps improving public transportation, but also what kind of financing approaches they're going to take in order to finance these different technologies. So in this Remo Urban case, the retrofit model that was chosen was an energy sprung type approach. So effectively for social housing, local authorities financed the retrofits through savings from energy costs and repairs and maintenance. So again, just giving you an example of what finance could look like or how finance could integrate these neighborhood approaches, mindsets that we might see in the future as well. I'm going to leave us perhaps on this broader question. Thank you all, and I hope to see some good questions in our Q&A session as well.
Thank you, Anna. That was brilliant and great to look through those issues and those insights that you discovered, and we'll welcome questions later in the session. Over to Joey now, who's co-founder of CurveBlock. I'll pass over to you, Joey, and please feel free to introduce yourself. I understand that maybe there's some sound issues, so apologies for that.
No worries. Thank you, Natalie. I'm Joey Jones with CurveBlock, one of the co-founders that is working to impact the sustainable environment. I don't know that I have control. So next slide. So what do all these people have in common? Next slide. With CurveBlock, they all participate in passive income from a multi-million pound carbon zero, energy positive real estate development fund. Next slide. The problem is the public is not the primary financial beneficiary of the construction sector. And as we've discussed here today, we have an additional challenge that the construction sector is not focused on carbon zero energy positive solutions. While those are slated to come, most of the industry will wait until the rules are in place to make that transition. Next slide. CurveBlock's solution is very simple. We allow people to register through our platform. They will be able to participate in the revenue share, browse the different projects that are on the platform to see what is there, but all participants will participate in all projects. So they have a diversified portfolio without the need to understand the due diligence process of figuring out which project to invest in. Next slide. So what does CurveBlock invest in? We invest in carbon zero, energy positive new home developments. So all of the homes that will be built are zero carbon emissions. They use no fossil fuels of any kind. They produce more energy than they consume. So that allows for the homeowner to do a couple of things. They can either sell that excess energy back to the grid and have a source of revenue, or they can use that energy to power an electric vehicle for up to 20,000 miles a year, which is a savings of circa 4,500 pounds a year or so. Next slide. CurveBlock currently meets 9 of the 17 UN sustainability goals through a number of different metrics that we use to employ. Next slide. So what has CurveBlock done? We started in 2018 with our concept. We've created the live click model. We've sold 2.2 million, a little over 2.2 million digital shares with zero customer acquisition cost at this point. We have filled and closed our SEIS round, and we have a little over 110 million pounds of real estate development value in our current pipeline. And that is currently growing, as we add new projects to the project. Next slide. So the business model is very simple. We collect investment from the public. We purchase or partner with companies or individuals to purchase land. We build the homes, we sell the homes. Profits are shared equally with our community, and we rinse and repeat. Very specifically, CurveBlock gives 5% off the top from profits to a charity that we have established. Curb Block helps specifically to help with the homeless and lower income housing needs there in the UK. And then the remaining 95% is split 50-50 with the community, meaning that Curb Block actually keeps less of the profit than we give away. Next slide. So what's the size of this market? The real estate market is the largest asset class in the world. Going back to Shally's point, the real estate market overall is considered to be about 30% of the carbon emissions between commercial and residential. So it is a big issue to tackle. Curb Block participates in both the real estate, financial markets, and then also the digital asset market. So three of the asset classes covering 70% of global markets. Our initial target is of course the 66 million UK adults. Next slide. So how do we get to these people? So there are people that are charging thousands of pounds, multiple thousands of pounds for courses and trainings for people to learn about real estate and about construction and how to invest in real estate. We intend to give all of that information away for free and help people understand what they're doing, but at the same time do it for them so that while they have the knowledge, they don't have to do it themselves. Next slide. Where does Curb Block fit into the overall marketplace? The most similar thing to us is crowdfunding, which you may be familiar with. The big difference between crowdfunding is us. There's some major differences. One, we bring liquidity, so the investor can get out when they need to. We don't require the investor to be able to do the due diligence on their own. They don't have to have an immense knowledge of the real estate space so that they can be an investor, and then they actually participate in the growth of the development. They don't loan money to the developments like most crowdfunding. Next slide. We are on track to meet our financial goals at this point. Next slide. Next slide. Oh, sorry. So the team, all of us have a construction background. My two co-founders, Matt and Gary, that's all they've done in their careers has been in the construction sector. I grew up in the construction sector, but the first half of my adult life was as a registered investment advisor, owning an investment advisory firm that I exited a few years ago. And then we have two other gentlemen that both have construction backgrounds as well. So we are not technologists, we are from the construction sector. Next slide. So what is the model? What are the challenges? Some of the things that need to change is we need more government involvement. There's a lot that the government is saying they want to do. There's not a lot they actually are doing. Corporate funding for these things. We see a lot of businesses that say they want to invest in ESG projects. Those businesses aren't having conversations with us as Curb Block. There is a number of ways to innovate. One of the underlying challenges that the Curb Block is trying to surmount is removing the bank as a primary lender on these projects, because in difficult times, bank money dries up and you can't move forward, which is where people that are liquid tend to be wealthier people, take advantage of those situations and buy everything on a fire sale. Curb Block intends to do that as well. So if we remove the senior debt of banks, then we can then finance ourselves. There are some innovative things that we can do with finance, since the homes that Curb Block builds produce more energy than they consume. We do see a future where mortgage lenders could take first charge of that excess energy for some period of time and use that excess energy as the down payment, making it easier for people to get into these carbon zero energy positive homes. Speaking of that, these carbon zero energy positive homes don't cost more to build than a standard brick and block construction. So that was one of the first challenges that we had to overcome, is making sure that we weren't extremely more expensive to build these types of products than others, and we have overcome that particular goal. So it makes it easier for people to participate. That is the curve block model. I look forward to questions when you have time, and I appreciate the time. Thank you.
Thank you, Joey. Brilliant. Now over to our panel discussion, and our colleague Dan Rogers from Connected Places Catapult will be chairing this next session. Over to you, Dan.
Thank you, Natalie, and welcome to the next part of today's event, the panel session and Q&A. So, yeah, as mentioned, I'm Dan. I work with Natalie in Connected Places Catapult, and I'll be chairing this event. And we're going to gather our panel of speakers to talk in a bit more detail about some of the innovations and the barriers that have already been discussed today, and see if we can agree some of the steps that could be taken to move the sector forward. We'll also be opening up for questions from the audience, so please do share your questions by clicking on the Q&A feature on your Zoom screen, and we'll fit in as many as we can into the discussion as well. On the panel today, we have a few people you've heard from earlier. So we have my colleague Natalie from the Catapult. We have Shally of Vivid Economics, along with her colleagues Alessandro and Karishma. We'll have Joey at Curveblock. And we're also joined by Hamish McMichael, who is co-founder and CEO of Ambu. So before we get started, what I'd like is to invite each panelist just give a quick one-line on their interest in innovative financing. And Hamish, as we haven't heard from you yet, maybe if we kick off with you.
Okay, thank you. So I'm an architect and conservation architect by background, and I've set up a company called Ambu, and what we're trying to do is help people get the data to make informed decisions about how to make their homes more sustainable.
That's brilliant, thank you. And then perhaps we could hear from the Vivid team next. Shally, do you want to kick us off?
Thanks, Dan. I'm Shally Venugopal, principal at Vivid Economics within our sustainable finance team. We work pretty closely with banks and investors on setting up their ESG frameworks and figuring out how they can get exposure to green investments. So this topic is very relevant for us because it's this idea of connecting, as I said, finance supply with finance demand. So thanks for having us.
Perfect, thank you. Maybe Karishma next.
Thanks, Dan. Zoom's just told me my connection is unstable, so forgive any technological lapses that happen. So as Shally said, this area is of great interest to Vivid, and personally, a lot of my work has involved bringing data-driven approaches to sustainability. We've also looked at how different sectors can move forward in their sustainability journey using financing. In particular, we looked at kind of EVs in the US last year, and then working on this project in the built environment with Catapult.
Perfect, thank you, Karishma. And Alessandro?
Yes, hello, thank you, Dan, and nice to meet everybody. I've also been working in the climate change and decarbonization space for a long time now, for over a decade. I was at the Carbon Trust first, where I looked specifically at how to finance energy efficiency around the world, and finance, of course, innovation in that space was a crucial element of it. I then worked for a bank in the UK, Lloyds Banking Group, again, looking at how they could proactively decarbonize their portfolio, including both social housing, mortgages, and commercial real estate components. And finally, I joined Vivid, still working on sustainable finance, hence my presence here today.
That's great. Welcome to everyone from Vivid. Maybe now if we turn to Curveblock, and Joe, you've hinted a bit at your experience, but just talk a bit more about your interest in the innovative financing space.
Sure. So similar to what Hamish said, we're working at Curveblock to bring that data so that we can validate these homes and what they're doing. So to that end, we're finishing up right now with the digital catapult, and Wyra in the spring program, and that just finishing in that green challenge, working to capture all of the data that these homes are producing, from the energy they're producing to what's being consumed and where it's being consumed, and collecting all of that data so that we can validate that information for green finance in the future. Having a background in finance and in construction, trying to marry those two together to make it achievable for everyone to reach the goals.
Perfect. Thank you, Joey. And last but not least, pass to my colleague, Natalie. Do you want to talk a bit about how innovative financing fits into our your housing innovation role?
Thanks, Dan. Yes, I think it's an interesting part of our housing innovation strategy, looking at this innovative financing, because I think as this journey that a lot of the built environment sector are on at the moment, I'm a town planner by background and haven't necessarily thought before the last couple of years about our role as practitioners in supporting this transition, the role that finance plays in supporting that transition, and these blockers that are faced by the industry now. I think as practitioners and looking at placemaking and delivering sort of decarbonised housing, I think it's a place where a lot of people maybe attending today as well are at, and it's really an important thing to explore. So it's exciting to be releasing this report today.
That's brilliant. Okay, thanks everyone and welcome. So right, I'd like to start by exploring the topic of financing innovation. We've talked about kind of wealth of products in the report and touched on a number of them today, you know, sustainable housing bonds, green municipal bonds, wholesale green funds and facilities. I mean, the list could go on. Which innovative kind of finance and delivery products are most likely to both scale and have positive impact in your view? And maybe if we, I don't know if maybe the Vivid team would like to kick off.
Yeah, absolutely, Dan. I appreciate that question. I mean, I think that was one of the key challenges in working on a report that was focused on innovation, is that in many senses, we're throwing a bunch of, you know, darts up at the board and trying to figure out which one sticks. But I think from my personal perspective, from all of the innovations that we've reviewed, one thing was clear. You know, we have some incredible technology and data platforms coming out, but the question is, how do we marry that with the delivery as well as the finance? And putting those three together as a package is, to me, the real challenge. And so in that sense, I find the as a service models quite compelling, even if they face a lot of challenges to scale, because those are the models that are providing us that 3-in-1 service. And certainly, you know, services like Curve Block and also Ambu, you can think about ways in which the finance can come in various ways to sort of get to that scale. But to be honest, with innovation, as I said, we're going to have to try a lot of things and then see what sticks, because it's not just about having the business case, it's also about getting interest and excitement from everyday citizens.
Yeah, and I think, Shally, in that same vein, on the softer side of things, it's really important to have fora that bring decision makers and financiers together. So for example, what Connected Places Catapult is doing here, or also in the example that Anna touched on with Remo Urban, that's trying to test models for smart cities in the UK and Nottingham, and then also I think in Spain and Turkey. So they have used other innovators within their smart city projects, which kind of, again, comes to the point of looking at things more holistically from a sort of sustainable urban planning lens, rather than focusing specifically on how do we get this one flat to have better insulation.
If I could just raise a few points. I think some of the things that we just discussed earlier are really around how to educate and inform the consumer. And I think one of the key challenges is about knowledge and data about people's existing assets. And I'm particularly interested, obviously, in the retrofit of existing buildings. And I think one of the challenges is, how do you validate some predicted improvements to a property, and then sort of quantify that and account for it. And I think one of the real challenges I think is interesting to bring up is around the energy performance certificate, because this is the sort of benchmark data that people can get hold of. And all the sort of discussions around the government bringing in policies to make mortgage lenders track the loan book EPC ratings of their properties. The problem is this data is actually a bit ineffective at the moment, and that's me putting it politely. We've been looking into the data that we can find, and there are a lot of errors. You can look at two very similar properties, and the way they've been surveyed and that data's been captured, it's not really that credible in some instances, and there's the potential risk for fraud as well. And so I think as more and more sort of dependence becomes on sort of benchmarking one property against another to sort of validate, there was talk about improved mortgage loans and products like that, we need more trust in the data that we're starting with, and I think that's a real challenge. And then it ties into this discussion about building renovation passports that's been brought up as well. If this is a product or a tool that can help people really understand how a building currently performs and what's been done to it, I think it's this sort of data which will help inform people and give the consumer the confidence to sort of believe in the products that are offered to them.
If I may hop in as well, Dan, I think as sort of colleagues have set out earlier in this session and in the report, I think the role that locally targeted instruments can play is really key here. So that you can that role of like testing at a small scale and in a way that actually suits the local needs, and every place is different, and there's so many different composite indicators that create different places and different needs, and I think that local approach is really key here. And I think we set out a number of examples in the report, but where those sort of sustainable housing bonds and green municipal bonds could play a key role for local authorities to really capitalise on. Thank you.
Brilliant. Shally, I think you wanted to jump in there.
Yeah, I think there are two other points that came to mind after this discussion. The first is the importance of social housing providers as providing a forum for us to test some of these innovations. Many of these innovations, the biggest challenge they face is simply demonstration that it can be done at scale. And so if we can convene the right folks to make sure we have an opportunity to undertake this demonstration, that's really going to tell us which darts are sticking on that board. The other thing that I wanted to mention is the role of commercial banks in innovation. And a lot of commercial banks, I think, have traditionally had to stick to very low risk investments. And when you think of low risk investments, the first thing that comes to mind is like, let's look at what has already been done in the past. We are in a real paradigm shift, like the tectonic plates are moving underneath us as we're thinking about this net zero transition, and everything's going to be different. We can't look to the past necessarily to know what a low risk investment is anymore. And I think that that's a key thing I want to sort of emphasize on the investment community side and the financiers, that when we think about net zero and implementing net zero and portfolio emissions, there's also going to need to be a thought about reaching different types of business models and customers than what we're used to. And that goes to that point of sale conversation that Anna brought up in her session, which is it's not just about process, it's also about people and getting the right people to buy into the new net zero shift that we're moving into, and what can these businesses do, not just because it's the right thing to do, but because it makes business sense from a risk management perspective.
That's brilliant. Thanks, Chad. Joey, I think you wanted to jump in as well.
For Curveblock, we've been trying to figure out and work on how to work within the current paradigm. That it is challenging to get people to shift paradigms, especially when it comes to finance. So we have worked on making the homes cost the same or even less than a traditional home. So that's the first challenge. Years ago, back in 2000, I was building energy positive homes, but people didn't want to pay the 15 or 20% extra cost that it cost to build those homes back then. So now we've gotten that price down to where that keeps it competitive. And that's one big challenge. That for us, the challenge then is working with the various councils and the planning authorities that move towards this idea of carbon zero energy positive homes and giving preference to that type of construction, and finding those that are willing to do that. Our first project is slated to start here in the Kent area, and it is in an area of outstanding natural beauty, which is a pretty big accomplishment for us. But finding the partners that have the land that they want to build on and building these types of homes as opposed to traditional stick builds is the type of partners that we're looking for to get this moving forward.
That's brilliant. Thank you. Joe. I mean, in terms of the kind of people's role in that paradigm shift, maybe if we could turn to the role of sort of financial institutions and or capital markets providers, those who have kind of net zero targets, how can they support this activity?
Thank you, Dan. I think I would like to take that one, given my background in banking as well as my previous experience. And I think I wanted to bring in a few of the strands and comments that other people have made. I think Hamish, the point on capturing that data going beyond the EPCs is absolutely crucial. And it kind of ties into this net zero goals question, because banks such as NatWest and Lloyds and some others are setting targets on their mortgage portfolios, for example, and those targets tend to be based on EPCs because that is the data that is available. And for a bank that has millions of mortgages, they are not going to be able to interact directly with the consumer and asking for emissions that are not measured or anything like that. So they need to rely on whatever data is in the market. So improving that provision of data and making it more realistic, going all the way down ideally to even energy consumption or similar, will be a crucial part that will then enable the finance to be scaled up. Because at the end of the day, what financiers are looking for, as Shaldi mentioned as well, is to reduce the risk as much as possible, reduce the uncertainty, and challenge they face right now is that they have increasing risk from the fact that inefficient homes that produce carbon emissions might become stranded assets, so might become unsellable, unrentable, and thus might become defaulted loans on their books. And this is a huge challenge for banks who have half of their exposure to mortgages. But in the other hand, they don't know which of those homes might become stranded assets, really, which ones are the good ones they should keep, which ones are the good ones they should invest in, or what is the right kind of renovation financing they can provide. So again, improving these sort of the valuation ecosystem so that it captures the benefits of a low carbon home, and that those benefits are then translated into financial benefits that a bank can recognize and put on their books, is essential for this scaling up to happen. And once that happens at the sort of mortgage issuer level, which is the retail banks, then that information can be passed on to the institutional investors as well, which might take the mortgages in the form of an asset-backed security, a green bond, for example. We've seen the example of Wheel sort of packaging up energy efficiency loans and securitizing them and selling them on the secondary markets. Again, if there is that better data at ground level, at project level, if there is that better understanding and that reduction of risk and uncertainty, then that's when finance can be scaled up more effectively. And so there are many different organizations that can help on this front. Banks have a role to play, but not just banks. And so how we get to that point, to that better knowledge and understanding in the market, is crucial for then finance to be sustainably scaled up.
Brilliant, thank you. Hamish?
Yes, so I just wanted to sort of add, Bayes did a report in 2013 that looked at the correlation between energy performance certificates and average property sale values in certain locations. And the academics at Cambridge University who did the research, they're actually in the process of updating it again now. And it's going to be very interesting to see how that correlation has changed in the last 7-8 years, because obviously everybody's a lot more kind of concerned, and this has risen up the agenda. And I think it's very interesting to think about how the value of the property as an asset, if it had some investment in it, to make it more retrofit, to make it more sustainable, if that goes up, can that change people's perception about how they might choose to finance this as well? Because at the moment, the discussion around payback period, if I spend £20,000 with an air source heat pump and solar panels, but it's going to take 30 years to pay that back, that's, it's not a very compelling argument for people. But actually, if they get that benefit immediately because the EPC certificate goes up and the value of the property goes up, then all of a sudden that payback massively shortens, and it can really change people's perception about, is this worth me making this investment myself?
That's brilliant. Thank you, Hamish. And we do have a follow-up on the EPCs question, which we'll come to in a second. Shally, let's see.
Yeah, I was just going to follow up on that point in particular. It's one that we didn't emphasize so much in our presentation, but it's very important. so far, the research doesn't support the fact that resale value increases with decarbonization, and that's a big problem. It's a significant problem, and I'm not sure if it's a problem that has to be solved with multiple angles. So the right policy signals, certainly, but I think there's also a lot of work to be done with appraisers and surveyors to ensure that their processes take this into account. And at the end of the day, you know, we have a couple of levers like resale value. We also have our financing. So if we're getting lower interest costs, that sort of builds into that overall price for acquiring that home. But we need the data and research to back it up.
So while we're on that topic, we've had a question come in about the kind of increasing confidence in EPCs through better quality data. So how do we do that? For example, they've mentioned the resistance from homeowners to installing things like smart meters. Hamish, I don't know if you wanted to kick off on that one.
Yeah, well, there's another Bayes report that actually they have a strategy for improving EPCs and their roadmap. And I think their survey showed that only 3% of homeowners actually think the quality of the data is good. So, I mean, this is a massive problem. I think the thing is, the EPC is very static data. It doesn't actually take account of the sort of personalized, the way people live and their lifestyles. So, for example, if you could have two households with the same house, but if one person lives in one and 5 people live in another, that has a massive effect on actually what the energy costs are going to be. And this sort of data isn't reflected in the EPC. And I think then the real problem is when people make predictions about, oh, I'm going to save this amount of money by installing this retrofit measure, it's actually pretty inaccurate, and you get this performance gap where people start to lose faith in the data and trust. So what we really need to do is take the EPC as a benchmark between 2 different properties, but start to add on additional data so people can personalize it and get much more accurate predictions about how much I'm going to save by putting in an air source heat pump, for example. And the air source heat pump is a real challenge because at the moment, if you add one to a property, it lowers the EPC rating, bizarrely, just because of the way the EPC is calculated on energy costs, and electricity is weighted differently from gas. So there needs to be some policy changes in that, which will start to encourage people to go for these low carbon heat sources, or else we're fighting a losing battle.
Brilliant, thank you, Hamish. Joey, did you want to jump in?
Yeah, and on following on with Hamish, is that data is the challenge, right? So it's education of these appraisers to get that value up, and because they don't have faith in that data, they're not changing values of homes. It's not the same thing, but similar. So here in the U.S., where I am, home values are skyrocketing. I mean, literally skyrocketing. There's land values that have doubled in 1 year, and home prices have gone through the roof. And the challenge with that is that the appraisers are still appraising on last year's value, not this year's value, which means that people go to buy a home, they have to pay more than the appraiser says the home is worth, and now they have to have the cash in hand to buy those homes. So the way that's being now challenged is that the realtors are then going with all the data saying, here's what all the homes have sold for, here's what the data is, and that's allowing these appraisers to start changing the values and increasing the value so that the people can continue to buy homes. The same thing needs to happen with this data. The data has to be there, and then we have to be able to show the data so that we can get these appraisers to get that value where it needs to be, and some adjustment. And until that happens, then banks' hands are kind of tied. They have to go by the data that they have, and unfortunately, it's not positive at this point.
That's brilliant. And I'd just like to move on to social housing providers in a minute, but just while we're on this topic, and Natalie, please do kind of include this in your comment as well. We've had a comment about the work that Bayes did on linking EPCs to house value. Some saying it was helpful, but for South East and London, the connection was not statistically significant, and location was kind of as ever, it was all about location. Do you think this might change in a post-COVID world where concentration of people needing to be near London might significantly diminish?
If I may,
sorry.
Go first, Natalie, and then.
Okay, thanks. Well, my reflection actually that I was going to say it sort of leans on this, an answer to this question as well. But I think it's a really important question, and in a post-COVID world, the need for the role of data in the wider digital transformation of the whole built environment is is like never before. It's really identified that need, especially with everything having to move online, and you've seen councils having to move to virtual planning committees, etc. So it's really pushed that conversation forward, and it really increases the sort of importance as we've been looking at the Catapult across all of the built environment work, but the role of standards, especially data standards, in supporting that digital transformation, which then leans, looking into how to support that through innovative financing models too. But so in terms of the importance of that is that, other industries haven't digitalized without, that paradigm shift always needs support from sort of cross-sector collaboration. And so the banks and financial industry will really need to work with the built environment industry in order to make a successful transformation in that way. And I think post-COVID, I think it's really sort of pushed that forward as well, that we've seen a lot more collaboration in the sort of pandemic space. So climate emergency will also need to be dealt with in a collaborative way too. Hamish, did you have further comments?
Yeah, I was just going to say, I mean, the data in the Bayes report was, I think, from 2006 to 2012, so it's quite out of date. And there have been some policy shifts already, which is going to have an impact on that. So, for example, the MEES 2019, this minimum energy efficiency standards that private landlords have to get their properties up to a band D and then a band C to be able to rent them out. I mean, this is going to drive an awareness and the need to be doing these retrofits. And my understanding is that actually the devolved government in Scotland are consulting on the idea of having minimum energy efficiency standards at point of sale. And there's some discussion about whether that's going to be in 2028 or 2025. And that's going to have a massive impact as well, because people will start to realize, they've got to do this work to be able to put their house on the market. And all of a sudden, people will start comparing the like for like and thinking, well, this one's going to be an easier job to retrofit than that one. So I think these sorts of policy shifts are going to have a massive repercussions.
Brilliant, thank you, Hamish. As I said, I'd like to provide a little bit of time to talk about the social housing as well. We've had a question in, a kind of comment and question here, that there are a couple of challenges. The first being kind of finding a legal mechanism allowing kind of organisations to reclaim some benefit of energy retrofit from social home retrofits. So overcoming the sort of tenant-landlord split to pay back capital financing. And the second challenge being that when we address blocks with social residents and leaseholders, having finance mechanisms that work seamlessly for both groups of residents, particularly for leaseholders, as the organisation can't offer credit. What are our views on sort of solutions or ways to address these two particular challenges? Maybe Shally, if you wanted to start on that one.
Yeah, absolutely. This is something that we spent a fair amount of time thinking through in the report. I won't go as far as to say we have all the answers, but one conversation with the Housing Finance Corporation really stands out to me, and we were kind of brainstorming with them, mostly hearing from them the challenge that they face. With financing new builds for social housing providers, it's much easier for them because there's a revenue stream in place, and certainly the funding bias sort of goes to that. And so the question is, like you said, what is the legal mechanism? For us, we focused a bit more on what is the financial mechanism. So we've been thinking a bit about central government guarantees that could come in either at the Housing Finance Corporation level or at the Housing Association level to come in and reduce the cost of finance, whether it's through guarantees or an actual just like discount on finance for retrofits. Because at the end of the day, we need to create some type of incentives for undertaking these retrofits. And right now there's no revenue stream because of the lack of legal framework. So we have to address both of those questions at once. Like I said, no answers on the legal side, but at least on the financing mechanism side, I think there's ways to tackle it if we get the legal part right.
So if I can just jump in on the social rental sector, the Retrofit Academy had an interesting seminar last week, and somebody from Nottingham City Housing, I think it was, presented the Energy Sprung project in Nottingham, which is a beautiful scheme, and they've retrofitted a sort of a row of terrace houses, I think 10 of them. But the problem is that 2 of those houses have obviously been sold off in the past, so weren't owned by the Housing Association anymore. So there are 2 which stick out like a sore thumb because they haven't been upgraded. And actually, this ended up costing the Energy Strong and the Housing Association probably more money, because they had to stop and start the details of the retrofit. And they've actually identified that the houses either side of the one which hasn't been upgraded, their energy bills are higher because they're losing heat through the party walls into the undeveloped house. So there's a whole discussion about how do you sort of deal with these mixed tenure developments, and where there's a bit of pepper potting of different properties. And it could be something like the PACE scheme that Vivid Economics were talking about earlier, where if some of those measures and those costs were put into some sort of mechanism that money can be recovered through being attached to the deeds or the title of the house, that could be a way of kind of offering people very low cost finance, so that it's a no-brainer that they do these works, because it'll pay for itself and it's not going to come with this big upfront cost.
Brilliant, thank you, Hamish. I'm just going to try and squeeze in one final question, as it's related and quite interesting. So one comment has been that one of the attendees says they've done some research with social landlords and found it was varied how they consider net zero / kind of low carbon, and that this lack of standardization is a barrier to scaling investment. Is that something we've considered, and how could this be overcome with the different models that have been mentioned? I think, Alessandro, did you want to jump in there?
Yeah, I think again, it's a very good question, and speaks to a point that has been made many times in the financing for energy efficiency and decarbonization space, which is that sometimes the money is there, but what you don't have is bankable projects or an understanding of what the right projects are. So in a sense, for some instruments that we have discussed, such as green bonds and green mortgages, the banks themselves or independent organizations such as the Green Bond Principles are setting the definition of what green is, what low carbon is, and they're trying to be as strict as they can, although sometimes those definitions might, for example, be based on EPCs, which, as we have discussed, might have some issues, but at least the definition is there and people can argue with it. In other spaces and in other instruments, the definition has not been made as clear. So there's definitely a space there to sort of work on defining exactly what low carbon means and improving that, because then having a clear definition always helps with the finance as well. And yes, that can be in any form. So it's not just about defining what it is, but also sort of trying to standardize as much as possible the type of projects, again, so that financiers don't have to have the energy efficiency understanding themselves. It's something that they can just take as given because they trust organizations they're lending to. So that sort of ecosystem support and transaction support, as we've called them in our report, are essential to unlock finance.
Perfect. Okay. And Shally, I'll hand over to you very, very briefly.
And if I can just...
Oh, sorry, Karishma.
Go ahead, Karishma.
Sorry, can I just jump in for one final comment on that? I think in terms of differences with local authorities, there's a difference in the level of interest, which I think can be addressed by Hamish's point of this inevitable march towards net zero. Eventually, regulations will come into place that force everyone to be interested. And then there's also the difference in capacity of being able to implement kind of financing for these type of houses. And Alessandro touched on one point, which is the enabling environment, but there's also the actual instruments themselves. So you can have different varieties of green bonds or a community municipal bond, which is raised through local residents. So that gives you kind of different levels of capacity, which you can come in at. And sorry, with that, I'll hand back to Shally.
Oh no, I was going to say the same thing, just the plethora of options we have on the financing side, but certainly has to come with the policy.
Perfect. Thank you. Right. Well, I think that's all we have time for today. And so I'm going to give Natalie last kind of couple of minutes to wrap up the event. So apologies if we didn't get around to your question. There were so many really kind of interesting ones to get through. And if you have a specific question you'd like to follow up with either the Catapult or the wider panel, please do get in touch with us and we'll pick it up offline. And then just leaves me to say thank you to the amazing panel today. Great job. And Natalie, over to you.
Brilliant. Thank you, Dan. So summary and next steps. So this session and in our report, we've highlighted the catalytic role that finance can play to support innovation and transformation towards a sustainable residential built environment sector in the UK. We have heard how sustainability solutions can include targeted energy efficiency and low carbon heat measures, but also encompass a broader place-based approach to rethinking our built environment to meet health, inclusion, and environmental goals. Sustaining this momentum will require a carefully calibrated mix of public and private finance that complements policy interventions to address barriers at each stage of market development. At the beginning of this session, I set out how Connected Places Catapult's unique positioning can support the built environment industry in their next steps to decarbonise housing stock and create net zero places and communities. We are keen to convene key stakeholders and ecosystems to work collaboratively, connecting them with SMEs and innovators to collectively solve these problems. For example, we've heard there's a clear role for an opportunity for local authorities and housing associations to work with innovative SMEs and housing providers to pilot new approaches to decarbonise their existing housing stock using these new instruments and financing mechanisms that we set out today. We've also heard about the exciting potential for placemaking practitioners, including planners, developers and construction firms, to work together with local authorities in their placemaking and planning schemes to pilot some new holistic neighbourhood approaches in the pursuit of delivering new builds and net zero communities. We're very experienced as well in creating test beds and pilots as a catapult to help drive deployment of innovative technologies and to demonstrate new approaches for better outcomes. So we'd be keen to look into opportunities where we could use that expertise to help create these local test beds and start small and learn how to scale up from there together. We're also experienced in designing the business case and action plan for different areas of industry, especially looking at the decarbonisation of housing stock and supporting this transition to net zero places. We're going to tackle market barriers and help accelerate and scale up innovation in those places. So we would love to hear from you if you would like to follow up on this session or explore any of the opportunities that you've heard about today.